Hedge funds have always been notorious for charging high fees, and now it appears to be a problem. The industry that manages over $3 trillion of institutional money has been under pressure for underperformance even before the pandemic hit the market, and this year's market volatility triggered losses and further redemptions. Investors claim that passive investment products became a better alternative to struggling hedge funds. And indeed, compared to passive investment products' fees, hedge fund standard 2 and 20 seems way too high.
The Sheikh will not see the value in paying above market.
2 and 20 is standard.
Was standard, not for an investment the size of ours.
This is one of those rare cases where size doesn't actually matter. We won't stone you if you refuse, but we will kick you out of our fund.
Sadly, that will never happen if 2 and 20 is your sticking point. Now, if you're willing to...
Don't even think of dictating the fees, Farhad.
So is the standard hedge fund compensation structure really that unfair? Does it lead to managers making much more money than investors? And if so, is there a way to change the standard compensation structure to achieve alignment of interest and reinvent the hedge fund industry? Before we dig deeper into the discussion about hedge fund compensation structure, it makes sense to take a step back and recall the initial idea behind a hedge fund. There's a common misconception that a hedge fund is just a completely unregulated entity where a manager can do whatever they want and take unlimited risks. Whereas in reality, a hedge fund is a structure to accommodate actively managed investment strategies that pursue an uncorrelated risk-adjusted return. And if anything, hedge fund is supposed to be a tool to reduce the risk of diversified portfolio. And so the main selling point of a hedge fund was that they are flexible enough to pursue certain highly profitable strategies that mutual funds and passive products could not. And so the compensation structure was different. In addition to a flat management fee, there was a profit share component, often referred to as performance fee or an incentive fee. So 2% of assets under management and 20% of returns, also known as simply 2 and 20, became the gold standard of the hedge fund industry. And now, decades later, it seems like nobody's happy with this compensation structure. Investors keep pressuring to lower fees across the board, and emergent hedge fund managers are struggling to survive. But what's interesting is this whole debate about the unfairness of the hedge fund compensation structure only started with underperformance. Back in the day when hedge funds produced stellar results, investors didn't mind to pay 2 and 20. But today, with interest rates at their historical lows and high equity valuations, expected returns are pretty low, and even with fees far below 2 and 20, hedge funds are still being criticized. So perhaps the problem is not in the fee rate itself, but in the fact that investors actually want to get what they pay for. And if we are to adopt a new industry standard for compensation structure, the goal should be to align the nature of the investment product with applicable fee structure. And one way to do that is to stop charging management fee and performance fee simultaneously, because they belong to very different types of investment products. A management fee, a flat percentage of assets under management, fits perfectly to compensate a manager for running a commoditized strategy, whereas an incentive fee or profit share is a perfect way to compensate a true alpha-generating hedge fund for producing positive risk-adjusted return through skill-based active management. The initial purpose of the performance fee compensation was to attract talented hedge fund managers and to incentivize them to deliver better returns for their investors through profit-sharing arrangement. The problem is the way it was established as a flat percentage of gross returns sometimes creates unintended incentives. It doesn't take into account the risk taken to achieve that return. In other words, it compensates higher returns without any regard to volatility. Because the performance fee generally can't be negative, for investment managers, such a profit share arrangement is essentially a long option. Now, obviously, hedge fund managers are trying to maximize their potential bottom line. And so this optionality creates an incentive for the manager to achieve higher returns even at the expense of higher volatility and greater risk. For example, with a standard performance fee of 20% or even 30%, a manager can just purchase higher returns through leverage with the only intention to charge higher fees. And the more investors pressure fee rates down or implement hurdle rates, the more they incentivize a manager to artificially inflate their returns. But that's not what investors wanted. Investors are actually after positive risk-adjusted return, and a standard measure for such is Sharpe ratio. Sharpe ratio is also often used to judge a manager's skill. And a manager's skill is exactly what investors are buying when they pay performance fee. So logic suggests that performance fee based on Sharpe ratio rather than gross return makes much more sense from the alignment of interest perspective. If a hedge fund manager takes an excessive leverage just to artificially increase their returns, they will automatically increase their volatility, and it's not going to help them improve their Sharpe ratio. So if they compensate it based on Sharpe ratio, there's no incentive for them whatsoever to artificially boost their returns through leverage. And so this compensation structure actually creates the alignment of interest, not only in terms of maximizing returns, but also in terms of maintaining an acceptable level of risk. It may sound a little bit more confusing than 2 and 20, but the methodology doesn't have to be too complex. A standard hedge fund performance fee rate can be calculated as an annualized Sharpe ratio multiplied by 10 and capped at 50%. Now, this multiple can change throughout the fund's life cycle. For funds that already established their track record and investors started competing for the capacity in the fund, the multiple may be much higher and the cap may be removed. And for younger emerging managers, this multiple can start a little bit lower. But in any case, such an approach will provide investors with the flexibility to negotiate fair and dynamic compensation structure and attract and retain talented hedge fund managers with high Sharpe strategies. What about management fee? Many hedge fund managers justify charging management fee by the necessity to cover costs of doing business. Indeed, they need to pay their bills even before they raise capital. But if we look at management fee as a reimbursement of expenses, that creates quite an asymmetry. Think about it. An investor essentially pays for the manager to build their infrastructure and to build their team and to purchase research and data. And then if something goes wrong and the investor needs to redeem for some reason, they leave without having any exposure to the product and the infrastructure that they essentially paid to build. And so it would be fair for hedge funds to cover those initial expenses the same way as companies do it in all other industries, through raising debt or equity capital. And here's where hedge fund seeding business comes into play, where investors actually take equity stakes or negotiate some sort of long-term revenue share arrangement with a hedge fund manager. And today, as more and more hedge fund managers are actually becoming technology companies, it makes even more sense for private equity and venture capital investors to start looking at hedge funds as an investment opportunity. So back to management fee. Management fee is not supposed to be reimbursement of expenses. It's supposed to be a payment for services. And it is a perfect way to compensate an investment manager for running a commoditized investment strategy. That is a sort of an access product. In other words, it provides an exposure to a certain benchmark or a factor or a combination of factors, but not a skill-driven alpha. And honestly, many teams that position themselves as hedge funds, they in fact run this kind of commoditized strategies. And even with fee concessions, they struggle to raise capital as a hedge fund because investors just don't see an alpha component in their strategy. At the same time, commoditized strategies are often very scalable, and those managers would be much better off if they charged management fee only and focused on raising capital. This is not to say that management fee has to be necessarily 2% or lower, or it has to be the same across the different products and different asset managers. In fact, some of the more complex factor-based strategies are difficult to build and maintain, and it is only fair if they charge much higher management fee versus, for example, a simple index replication. But the main idea here is that both the manager and investors are aware of the fact that those are beta-driven strategies or factor exposure. There is a flat management fee and there's no pressure to deliver alpha. After all, not everyone is meant to be a true hedge fund manager. It is a skill-based game, and it is natural that it's highly competitive and there's only so many winners. Now, commoditized strategies, on the other hand, are by no means useless. They're actually very useful, and if anything, they're suitable for a much wider range of investors than hedge funds. It is only a problem when an inappropriate fee structure is applied. An AUM-based management fee works best to compensate for a disciplined, transparent approach in building commoditized strategies. Incentive fee works best to attract alpha-generating talent and access limited capacity of high Sharpe strategies.